Hi, everyone. You do not want to miss this episode. We're going to pull back the curtain and reveal the 10 myths your financial advisor wants you to believe. Behind the scenes financial planning right here today on Control and Compound. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell. Joining me as always, Christina Wyatt. Christina, how you doing today?
Hey, Darren, I am doing great today. Excited for another podcast topic that I think is going to be pretty neat. Pulling back the curtain. This could get interesting.
Yeah, I think sometimes in financial planning, people, financial advisors try to make things complicated and kind of smoke and mirrors and stuff. So I think this is going to be a great episode to pull back that curtain and see if those myths hold to be true or not.
So before we get started, though, I just want to remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. And if you're listening or watching on YouTube, please like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
Okay, Christina. So we're going to talk about myths of financial planning today. I'm sure I've said before on a podcast, I marvel how 90% of the wealth is in the hands of 10% of Canadians, but the financial strategies that the majority of people follow are the 90% of people that have 10% of the wealth. So we're following traditional financial strategies instead of following the strategies of the wealthy as a whole, as Canadians. So today we want to go through some of those things that financial advisors say and just kind of break it down and say, maybe you should question, is this really the way it works? So we're going to try to dig into a couple of those things today. So where do you want to start, Christina?
So I want to start at, we've had this discussion before. This is one that just drives me and you crazy, is the RRSPs. So RRSPs are tax deductible. That is a huge myth, right? We've done a whole podcast on RRSPs and the myths behind them. So definitely check that out. We're not going to dig into all of it here, but I think one of the number one things that financial planners can sit down and when they're talking it through is RRSPs are tax deductible, right? You're going to put the money in here today. It's going to come off your tax return. You're going to get that money back. It's great, right? Why wouldn't you do this? Well, it's not tax deductible. It's tax deferred. You are going to pay that tax. It is going to come at a later date. Now, Darren, I asked you the question, do you think taxes are going to go up or are they going to go down before you retire?
Guaranteed they're going up.
So you are now deferring your taxes to when you believe is a higher tax rate. Now, I know you're not, so I know that you're not, but this is how this planning, it's talked about in financial planning every day, right? We're going to take these tax deductions. They're going to be great for you long-term. You're going to have more to invest, but what they're failing to talk about is what that looks like in retirement and what's going to come at the time when those taxes need to be paid, right? We're focusing on today, not tomorrow, which does drive me a bit crazy. So that's number one on the myths list.
Okay. Love that one always. Okay. Number two, people or advisors use the average rate of return, right? If you look at any prospectus, it's like this fund is average, this mutual fund is average 5%, 7%, 10%. And people look at the average and not actually the actual. And if you've heard me speak on stage, I often refer to this example is, if you had a 6% return this year and an 8% return next year, what would your average rate of return be, right? We're smart people. We know that's 7. Well, how did we actually do it? We added those two numbers together and we divided by 2 to get an average. So 6 plus 8 divided by 2 is 7. So if we look at a 4-year return and we say, year 1, you were plus 100, year 2, you were minus 50, year 3, you were plus 100, and year 4, you were minus 50. So for those of you who don't want to do the math, those 4 numbers add up to a positive 100. We divide by the 4 years and we get an average return of 25%. So if your financial advisor came to you after 4 years and said, Christina, listen, I don't want to say I'm amazing, but I'm kind of amazing because you just averaged 25% return. I'm a rock star. Why don't you give me a list of all your friends and family so I can call them and provide this same level of rock star investing knowledge to your friends and family? And you'd be sitting there going, well, wait a minute, Darren. let's do the actual rate of return, right? Not the average, but the actual. And if you start with $100,000 and in year one you earn 100% return, you've now got 200. You lose 50% year two, now you're down to 100. Year three, we're up 100%, so we go back to 200,000. Year four, we lose 50%, we're down to 100,000. So you started with 100,000 in year one, and after year four, you still have 100,000. So your actual rate of return is 0, but your average rate of return is 25. Who cares what your average rate of return is? So those calculations, when they use average, they don't take into consideration that volatility. And for any of you that listen to us on a frequent basis, we know that volatility is one of those 4 wealth destroyers that the wealthy tackle head on and say, no, we're going to look at actual rate of return. And we'll do further episodes where we break this down and actual stock market returns. We can do that same example with actual stock market returns and prove that actual and average are 2 significantly different numbers.
Yeah, absolutely. And when some of these financial advisors are using these average rates of return, they're putting them into that 72-page document financial plan that they do up for you. And they use that average rate of return. And let's say the average rate of return is 12%. It's probably not, they're not going to use 25, but like 12%. When they throw that 12% in, it's showing that they're going to get that 12% every single year all the way up to retirement. Like, have you ever seen the market do 12% every single year without that volatility piece? It's
never
not
a down year.
It's not possible, right? We know that's not possible, but those projections that you're looking at are showing something like that happening, right? Which is really important to keep in mind, right? Because that's not what's actually going to happen. And if you're banking on that to be your financial plan, well, that's not ideal, right? We want to look for those things. And when you're talking to your advisor and they're doing projections out for you, make sure that they're not just using that average rate of return, 12% over the next 20 years, because I can guarantee you that's not going to happen. We know that, which does kind of bring me into the next myth, which is it's all about accumulation. So a lot of financial planners and advisors are also investment advisors, right? They do your investments, they manage your RRSPs, your TFSAs. And when you sit down for your financial planning session once a year, a large focus is on that rate of return, right? This is what I did for you last year. It was a great year. We're up this much, or, it was a bad year for everybody. We're down this much, right? That's typically how the conversation goes. It's all about that accumulation phase. And what we know is that the decumulation phase, those retirement years, are just as important as accumulating, because I promise you, when I sit down with individuals that are hitting retirement, they're not like, hey, how much money do I have? They're, how much money can I spend? That is the most important part, right? So how are we going to spend it? And when it comes to spending, we're really looking at, what kind of taxes are you going to pay to get it out if all of your money's in an RSP? Well, that changes things dramatically, right? So was that thought about before we hit the retirement side? It's super important, because taking it out and spending it in retirement is just as important as that accumulation phase earlier on too, right? We need to look at both sides, which I think gets missed a lot in financial planning.
Yeah, the analogy I use for that is the Sherpa, right? So you want to climb Mount Everest, and you go and you listen, I need to hire some Sherpas to help me. And this Sherpa comes up and goes, I can get you to the top of Mount Everest, no problem. I've got all kinds of experience in it. And you're like, well, sounds good. No one's died coming up the mountain on me. You're like, great. And then another Sherpa comes up and goes, well, I can get you to the top of the mountain, but I can also get you safely to the bottom on the other side. So we think of that as the accumulation. When you're saving, you hit the mountain, you hit the top of the peak, great, you're retired. Great, you have $1 million, $2 million, whatever your number is, and your advisor says, woohoo, we made it. Well, how do you safely get down the mountain? Or in this case, how much money can I take out safely and still get all the way down the mountain before I run out of money? And that's what I think typical financial planning fails. They look at what number can I save as opposed to what income can I have in retirement. And those are 2 very, very important distinctions.
Absolutely. So we could talk about that one for longer too. I'm sure we can dig into that, but I'm going to move on to our next myth. And this one, I'm sure you've heard of it before. buy term and invest the difference. We've all heard this, right? Let's buy cheap term insurance. We'll get a term 10, very inexpensive to cover our insurance needs. And then we'll take the money that we would have spent on getting a permanent plan or a high cash value life insurance, and we're going to go and we're going to put it into the stock market instead. And overall, that's going to be much better for us because, we've bought term for cheap. It's a cheap expense, and we've invested that difference, and we're absolutely going to come out on top. That is 100% a myth. This strategy it's not a foolproof strategy, right? There's two parts here. Number one, you probably do need term insurance. Absolutely. If you want to protect your income, if you want to make sure your mortgage is paid off, those short-term needs for life insurance that will eventually go away can definitely be taken care of by term insurance. So you do need term. But getting a permanent policy or a high cash value life insurance policy is for a completely different reason, right? This is, we've talked about it a lot. This is our savings account. This is where we want to be saving. And then we can take it and we can go use it for our opportunities, deal with emergencies. But if you can use it for opportunities, then really it's doing two things, right? You've got your high cash value policy that's, cute. It's making around 5%. So if we sat there and we said, okay, well, I can get 10% in the market, then yes, the cash is going to be more. If you get 10% every single year, like you said you were going to get, yes, we run that. Absolutely, there's going to be more in that investment account than there's going to be in your high cash value life insurance policy. And I'm not going to debate that. Like the rate of return's 5. I think that's pretty good, but it's not amazing. But why can't we do both, right? We utilize that and asset strategy where we have our savings inside of our high cash value policy, and then we take it and we go invest it too. So why can't we do both, right? The strategy, the buy term, invest the difference doesn't make sense when we can actually buy term to cover the needs that it needs to cover. And then we can invest the difference, but we can also have our high cash value policy as the foundation of our financial planning, right? Why do we have to do one versus the other? So I don't like that myth.
Yeah. And, when is an opportunity going to come along? Oftentimes when there's a crisis going on and your stock market portfolio is down 40%, are you really going to access that money for the opportunity versus your cash value life insurance, more of a saving, stable portion of your overall plan? Not your only vehicle, but a portion. You're always going to have access to money when the opportunities present themselves. Then the next one, number 5, we're going to talk about. You'll be in a lower tax bracket when you retire and take this money out of the RRSPs, and people just accept that without thinking about it. So what 30 or 35 or 40-year-old business owner real estate investor is going to go, yeah, what I'm making now, this is as good as it gets. I will never make this much money ever again in the next 30 years where I will be in a higher tax bracket. Like you're telling a 35-year-old, hey, listen, if you save and do everything right, in 30 years, you're going to be poorer than you are today. So two points on this. One, most people aren't going to be in a lower tax bracket because even if your income does go down a little bit, taxes are going up. And the misconception is, if your income drops from 100 to 80, you're in this much lower tax bracket. Well, that's not the way the tax rates work in Canada. They're marginally increasing or decreasing rates. So, you might be 1 or 2 or 3% difference in that scenario. But what do you think the chances are taxes going up in the next 20, 30 years before you take that money out? And what do you think the chances of your income are going up? Well, if you don't think your income and your earnings and your wealth is going to grow in the next 30 years, I don't think you're dealing with the right advisor. So we're going to be hopefully wealthier in retirement. So the idea that we're going to be a lower tax bracket, you've got 20, 30-year-olds putting in like in a 15, 20% tax bracket, and then taking it out potentially down the road in a 50, 60% tax bracket or higher. Does that make sense? And I get the tax-free growth, but there's other vehicles you can have tax-free growth as well. So I don't love that one. The next one I struggle with when people talk about this is business owners and real estate investors need to max out their RRSPs. Now, and we'll have some accountants that'll talk about this. Business owner needs to take an income to max out his or her RRSPs, and a real estate investor. And I just don't buy into that. I believe if you want to be wealthy and you're a business owner, real estate investor, 3 places you should be investing for true wealth: yourself, your business, your real estate, or some other hard asset. And in order to do that, you need to be in control of your money. I don't think a business owner or a real estate investor should be putting money in RSPs if they believe they want to put it back into their business in real estate, like most of them do, or want to have access to it. I believe it's way better to put it in something like the cash value life insurance. The second part of that is, if I put money in my RSPs, I need to pay a salary and get that money out of the company. If I leave it in the company, I pay my 12% tax, roll it to my holdco or the trust in the holdco, wherever I get it to my holdco. Now I have 88 cents to invest. I would much rather invest 88 cents there than flow this money out, pay the tax, defer my taxes for 30 years, take it out probably in a higher tax bracket, and most importantly, miss all those opportunities that come along because I don't have access to cash. So if you're a business owner, real estate investor, I don't love RSPs for you.
I agree. All right, so moving on to number 7 here. And this is for someone that might be just starting out their financial planning journey and they're sitting down for, their first kind of sessions, and an emergency account is talked about. So this one is a pillar in any financial plan, is having an emergency account, 6 months, a year worth of expenses put to the side. If you're going to if you lost your job, if something happened, we have that money available. And a lot of financial planners will tell you that you have to keep that in cash, right? So, and we've talked about it, you do want that foundation. I 100% believe in having an emergency fund, an opportunity fund that's there, but it doesn't necessarily have to be cash. Cash is not great. We all know with inflation these days, it's not an ideal place. And you put it in a GIC, that's not exactly liquid if you have to break it. High interest savings accounts, they're okay, but like there are other better places that we can be building emergency accounts. Like, I believe that if the money's liquid and you can access it quickly, it is a form of emergency account, right? You've got the access to it. If something pops up, you're good to go. And with our high cash value life insurance policies, that's exactly what we have, right? They're completely, if we need access to our funds, we get those policy loans, no questions asked, the money's in the bank account. So you don't have to choose cash for an emergency fund, is what I'm trying to say. There are alternatives out there as long as you can easily access it. I know some people will say, well, I've got this much in equity on my home equity line of credit, that kind of thing. That can work too if there was an emergency. Like, you need to have access to it. I believe that the high cash value life insurance is the best place for an emergency fund, but having access to it easily, it's liquid, that's going to work too. It absolutely doesn't need to be in cash. So emergency account number 7.
I'd say I'm old enough to remember 2008 when the housing market collapsed. And if you had a line of credit on your house, boy, did you get a wake-up call, because when you needed it the most, all of a sudden your line of credit went away, and your cash value life insurance is never going to go away. It's going to be there when you need it for opportunities and emergencies.
Great point, Darren. Super great point. That, you definitely want an emergency account, but it doesn't need to be in cash. The next one I have on here for number 8, this one seems crazy to me when people say it. You need to take high risk to get high returns. It has to be done that way, right? Like, that is, and that is truly, like, if you sit down with a financial advisor and they're going through your risk tolerance questionnaire and they're asking you all those questions, and we get to the end and they're like, oh yeah, you can take on 60, you're in between 60% to 80% equities that you can take, and the rest needs to be in fixed income. If you feel that you can be in that higher risk section, that's going to be where you get those higher returns, taking on that higher risk. And I think, like, they use it from a stock market perspective, but like, let's think of it this way. Let's say you're a real estate investor and you go, okay, I think, what we got to do is we got to buy this property. It's never going to cash flow. The septic system's blown on it. The electrical's blown, but we're going to flip it. And because we've got all that risk, we're definitely going to get the highest return on this one. Like, that sounds crazy, right? That's not, you don't have to. You can take calculated risks, absolutely, which is what we want to be doing. But don't just blindly trust that those funds that they're choosing, because they're high risk, they are going to give you that high return. Like, Warren Buffett didn't make his fortune in the stock market because somebody balanced his portfolio and told him he needed 80% equities, and that's how he was going to do it, right? He went in, he found undervalued companies, he purchased those, like, he calculated what he was doing to make those returns. And if you are just blindly going with a portfolio profile of 80 to 20%, that's not what you're doing. You don't need to take high risk to get high returns. You can do your research. You can learn, you can take calculated risks, absolutely, to make returns, but take some time and do your due diligence always, and know what you're investing in, and agree with what you're investing in, that you feel that these companies, if you're doing the stock market, make sure that you thoroughly believe that the companies you're investing in are going to go up. Like, if you don't think that oil is going to do great next year in Canada, your portfolio probably shouldn't have it. You know what I mean? Take the time to learn about these things. High risk does not absolutely equal high return, and we know this. It's proven.
Love it. Love it. Another number 9. This one I hear sometimes, even just from individuals, sometimes accountants that aren't as up to speed on some of the stuff out there. I've always find the larger accounting firms we have great success with, because they're dealing with so many business owners and real estate investors that they know what makes sense for them. But one of the lines we hear is, you need to max out your RRSPs and TFSA before looking at whole life. So step 1, max out your RRSP. So we kind of beat that up already, talking about, as a business owner, real estate investor, I don't think you should be maxing out your RRSPs. You need to be in control of that. But if we just step back and say, well, what's the foundation of your financial plan? And the foundation of your financial plan should be an emergency / opportunity fund, a rock solid plan that's not gonna ever blow up, right? And that's what cash value life insurance is. It's the foundation of your financial plan for those opportunities that come along, those emergencies that come along, the ability to multiply that money and put it into real estate, business, or other Bitcoin, whatever investment you want to do. So, on the hierarchy of things, I love cash value life insurance. I really like TFSAs. TFSAs are great. You put your money in, it grows tax-free, it comes out tax-free at the end. The downside to the TFSA is you're typically in the stock market, so it tends to be volatile. So when those opportunities come along, your TFSA could be down, and it's an or asset. If I put my money in a TFSA, because it's not really a savings plan, even though it's called a tax-free savings plan, it's really, most people, a tax-free investing plan, right? So when you put in investments in something volatile, if the market's down 40%, are you going to access your TFSA to go buy a property? Probably not. But you have to do TFSA or real estate or coaching or in your business, versus the cash value life insurance is that and asset. I can do basically what I can do with the TFSA. After tax money goes in, grows tax-free, comes out tax-free. I get the added benefit of the death benefit and all the other jobs it can do. Plus I get that and asset where I can have my foundation opportunity emergency fund and put that money back into another investment, and now have 2 assets working for me instead of 1. So I don't think you should be maxing out your RRSPs and TFSAs before you look at whole life. And then we get to number 10, and this is good. So financial advisors, they can do it all. And you'll see some financial advisors, if you have a card from a financial advisor, flip it over into the back. Sometimes people on the back of their business card will list RRSPs, mutual funds, non-registered, disability plans, education savings plans, TFSAs, disability investment plan. Like, they'll list, here are the 22 services, group insurance, pension. Anyway, we can go on and on. Here's the 20 things I specialize in. And don't worry, I can do it all. And I really, as my career developed through the years, I just really saw how you can't be an expert on everything. There's no way you can be an expert on anything. So how are you specialized? What are you the best at? We believe we are the best at infinite banking. When you're talking to business owners, real estate investors, or individuals, we know this inside note. We do it every single day, nonstop, day in, day out. It's what we live, what we breathe. We're experts at it. In the office, we call our wealth coaches brain surgeons. They do brain surgery. They only do brain surgery. We're not going to come in and tell you, oh, here's a nice RRSP mutual fund we should do too. No, we are going to specialize in one thing, and we are really good. Do you want to go to your regular family doctor for brain surgery? Probably not. You want to go to a specialist. So when we're talking about this policy, because there's so many misunderstandings of the insurance world, how to design a policy, how to use a policy, how to maintain a policy, that I really think you need to be dealing with the experts that specialize in, and that's what we do at Control and Combat. Christine, anything else before we wrap up?
No, I think we covered a lot of the myths. I'm sure there's more out there. If you've got one, list them in the comments below. I'm sure we can have another discussion on that too. If you've got any you want to share, put them in the comments below and share those too. But I think that's a wrap for today.
All right. Thanks for watching. Thanks for listening. Have a great day.
Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.